You guys see it okay now? So
Slightly.
this one is basically a oh, here you go. Admit. Um, um, was that any helpful? By the way, I kind of went through fast at the same time. There's not a whole lot to it. There are much more better videos out there. Um, and I thought I could just share some stuff. So the basic introductions and um, does it make sense the difference between um, different types of options, calls and puts, and then buy versus sell? Any questions you guys have?
Ji Abdul Basir Saab, definitely it's helpful and it does reinforce our basic understanding of options. But I think it will be more beneficial if you can just demonstrate like an option contract itself, which is showing the time of expiry. Because you see, I think then it can demonstrate and connects the learning gaps.
And that's what I have this platform on my account have this, so I thought I could show you that. So this is something I could show you. Um, so just name any particular stock. Again, this does not have to be Tesla. I mean, you guys can just give me anyone that's say I don't know which one is more digestible or smaller one. We could go any one of these. Um, why don't you guys tell me about one particular stock and we'll stick to that? I mean, we can't use Ali's watch here anymore. So just
FCEL, fuel cell energy. I think it is
uh,
less than $10.
well, what is the symbol again?
FCEL.
FCL. Okay. All right. It does have options. That's good. All right. Um, so this particular one, let me actually here. So what you have, so here you could see it has option chain. So every stock would have option chain. So this one has a weekly option chain. So there's something expiring on December 24th and then January 25th. This actually have monthly ones. So there are no weekly ones here available. As you can see, they have end of December there's one, and then end of January, and then January they have weekly ones. They keep on expiring. Um, so let's take a look at the ones which are expiring on December 25th, all right? Um, what you see on the left-hand side are all options. What you see on the right-hand side is all the puts. I think it should say somewhere option chain, and well, these are all calls. Oh yeah, right here. As you can see here, these are the calls on the top, and here these are the puts. All right. So let's focus on the calls right now. So a call, this is expiring on December 24th. So you have 6 more days left. It does calculate weekends also, but technically you have only 5 or 4 days from Monday through Friday. So you can have this one is showing only a strike price of $10.50 11. You can actually expand that to as many you have available. All right. So this fuel cell right now it's probably trading around 11 something. Let me quickly jump to its current. Oh yeah, right here. Right now the last price it traded was when the market close was $11.39. All right, the volume is this, blah blah blah. So let's not go into those details. The intent here is so it has these are the multiple options of calls you can buy at different strike price. And Sarah, you were asking earlier, so uh, let's say, for example, the strike price of even though it's 11:39, 11:40, let's say we want to buy a at we want to buy some calls at 11:50. So all we're doing is you could buy a call, but the calls are priced at $1.02. So if I were to buy um, one call, all right, one call at the strike price of 11.50, I have to pay $1 for each, basically each call. That's a premium. Um, and then the expiration date of that is December 24. Confirm and send. Let's see if I could do that. So as you could see, what is the if I were to buy 100 stocks of FCell at 11.50, how much would I pay? About 100 some dollars, right? Or no, about $1,000. Guys, you need to participate a little bit more. I'm not the only one who's
Yes. But where is the premium? I'm trying to read the screen of this.
yeah,
This.
okay. So what I'm saying is, so if the stock is at 11, all we are saying is we want to buy this particular F cell at $100 at sorry at 11.50, and we're buying a contract for 100 stocks. So if you were to buy naked actual stocks by itself, 100 stocks at 11.50 would be how much? 11 times 100 is that's 1,000
1150.
something. 11,
Yeah,
1150, right?
1100 something. Yep.
1150. However, because you're only buying call options, so for one call option, which is equal to 100 stocks, you are paying $102. You're not paying $1,000, you're just paying
Got it.
$102. The $2 goes to NASDAQ, and then actually $100 goes to, let's say, whoever owns this particular stock, willing
Can
to
you come
sell,
again?
goes to him.
I missed your last phrase. So the reason we are paying lesser, why?
Because we are not buying stock, we are buying a guarantee to buy the stock. So you're paying the premium to buy the stock. So you're saying
Contract. Yeah.
you're buying a contract for at 11.50. So you're saying on 24th, what is the expiration date of this? December 24th. If the stocks, even though it remains at, let's say, if the stock goes to $15, still you pay at 11.50 a stock, and you'll buy 100 stocks. You have the contract to buy 100 stocks at 11.50 each on past December 25th, 24th. And to do that, that contract, that agreement, you're basically paying them $100. So if it doesn't go on 24, let's say stock remains at $11 or 11.50 or below 11.50, then you will lose this $102.
Gotcha. And how do you like distinguish it's a naked call or a covered call?
Oh, it's very simple. Naked calls meaning you do not own any stocks on it. So it's called naked call. Covered call is meaning, let's say I already have 100 stocks in my ownership. Let's say I have 1,000 FSL, and then I want to buy puts. That's when it comes in handy. Or I want to sell some options, call options. Then it will make sense. That's called covered calls. If I don't have any stock in my ownership, then everything is naked, meaning there's nothing to cover. So for example, let's switch to calls here for a second. Any question on this particular transaction? I'll just
So
put it in
if
our basket here, confirm and send.
so if we are buying like simple calls and puts without
Yep,
buying any underlying stocks, then they are
that's correct.
considered
They're
as
all naked.
naked.
Yep, they're
Okay.
all are naked. Yeah. Yep. So I don't have any FSL, for example. So if I want to buy puts at usually, as you could see, at this particular rate, because it's close, there's nobody's bidding anything. But let's say if I were to buy puts at um, you know uh,
So is it better to buy naked or covered?
um, I mean, calls are good if you want to do naked. Puts are usually bought against covered puts, because then what happens is if uh, so for example, if you buy puts and the market never goes down but it keeps going up, then you have to buy those stocks and to meet your requirement. So for example, let's say I do this at 90. Let's say I buy none of these going to get executed. That's why I'm doing this. So I buy these puts. Here we go. Um, as you can see, that there's security options saying, hey, I do not have anything. So it's telling me that I'm borrowing this. So I am basically getting a contract, one contract to sell 100 FSL at $11 a piece, and the premium I'm paying for that here I'm getting a premium of $900. So $900 will get deposited to me because I'm buying puts. puts basically gives you the option to sell that many stocks. So I'm collecting money. If I had 100 F-cell, then they will basically give me $900 for that, as if like I sold my stock. And if the stock goes down, then I'm good with it. But if the stock goes up, then I would lose the premium. So even though if let's say if the stock goes up by my expiration by $10, then I have to I only collect $900. I will not in my 100 stocks that I have to let go at this particular strike price.
Mhm.
If I were to execute this particular put option, and then let's say I get it, then I'm only good if the stock goes down. So if this was a naked, then if the stock goes up, and let's say Monday morning or Tuesday or at the end of expiration, the stock is at 1350, then if I do not have any underlying stocks, then on next week, my Thinkorswim will come back to me and say I have to buy 100 stocks at 1350. Even though I only got 916, then I have to pay 1,300, so I will lose a couple $100 on that.
Mhm.
Um, Another example, say, for example, just give me another stock. It's quite a crowd.
Well, you can start with Soxl, 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 yeah.
All right. So this one, obviously, it's trading at $30 a piece. So it's let's say if assuming that I have 100 stocks of this, I could actually sell some calls on it. So let's say I have 100 of these. I can literally sell. Why is it not doing it?
So that's like 100 puts, covered puts.
Yeah, you could say that, but it's not puts though. I'll tell you in a second. You don't have to. It's very similar. It's pretty much the same. So if I were to get so if I were to sell 100 calls of this, and if the stock, um, basically, if I have 100, if I have 100 stocks of this particular stock, and I basically sell it, then whatever strike price I sell, if the market still remains below that, then I'm good with that. But if the market goes above, then obviously I'm going to lose. So the sell calls very similar to put buy, and then put sell is similar to options calls buy. Very similar, but again, puts are usually they do require, like I said, most platforms you need to have some underlying stock on that. Let's see if it allows me to sell this. Let's see if I do this. Confirms and so and what you will basically do is when you sell, the only difference when you sell a call, you actually get the premium. So they will add. So here, what they're doing is they're giving me a credit of $1,000. That's a premium I will basically collect against on this particular stock. So if I already have it in my ownership and the stock never goes beyond this, then I'm happy. I'm just going to continue keep the credit. And if it does goes up, then I basically lose that many stocks and I can come back and buy it. So that's the difference between calls and sell calls versus buy calls. So for the easiest part, if anybody wants to start, then usually you want to do is buy calls, and then you hold on to that on the day of expiry. If the stock price goes $20 more or whatever the desired percentage, then you can convert your calls. If it doesn't, then you could let go the premium of that particular stock. So when you do sell a call, you get the money in your account. When you buy a call, you option calls, you basically pay the price, premium price for that.
And you sell the call if you have underlying stocks.
Not necessarily, just like how you can buy puts. Again, it all depends upon your ownership with them. Let's see if I could do this. I do not have the stock. Let's see if it lets me do that. Order is expected to place the account in a concentrated position. That's fine. This is all right. Confirm send. There it goes. Well, it rejected it because this particular account, I do not have a whole lot of buying power in it, so that's why I did that. At one point, when I had a couple 100,000, this they would pretty much let me do naked calls and all that stuff. It all depends. If you have, let's say, 50,000 in account, 500,000 account, and they will let you do different things. At the end of the day, the platform owners will basically do the you know, calculation based on the money you have in the account, and then they will let you take the risk. So where are my working orders? Okay. So I have basically, I would have these options, even though I do not have this is the only order that we placed earlier. If this order were to get executed, I would basically have a contract for the premium price of you know, $100 or whatever. But then I would basically, with one option, I could buy 100 FCell stocks at this particular price, even if at the end of December 25th, even though if the strike if the stock is at $20, I still get to only pay 11.50 per stock. So that's the option of that. Or the premium, the cost of the option call goes to, let's say, $5 at that point, because the stock has moved $5. Then I just get to when I liquidate it on Friday before the expiry, I'll just collect that particular premium. Any other question? Does this make sense? And you guys want me to go any more into anything else, more detail? So puts, usually it's underlying, but again, you don't have to. But puts are a lot more riskier than calls. Don't ask me why they are. But calls, usually I would start with buying calls and then execute that way. If I have stocks, or if I think a stock is going negative, especially like the way the setup markets might go down, so I would buy some puts. If I were to buy one put of Tesla, as you can see, it's going to be very expensive right now. All right, so
I had a question. So calls is you're buying, right? Then you say puts are risky. So how, like when you buy, sure, what are you doing next? You want to sell it at a premium, right? Or you want to sell it at an increase. So you, how do you sell back?
how do you sell back? Just give me one example, whether puts or calls. Which one? What do you have?
Calls, like I want to buy at a point, and then
Yeah. So let's say last Friday you bought or last week you bought let's say um, you know, one call of Tesla at, let's say, 430.
hmm.
All right, and then you paid at the time, let's say, $5, because last week Tesla was much low. So when you bought last week, you already bought a um, an option that's expiring, let's say today, I mean next week. But you can buy you know, calls into future also and all that stuff. So it does not have to be same week. So let's say you bought this particular call at $5 a piece. All right. But now, right now, how much is this? This is trading at 17.50. So for that same 430 strike price, now you can sell the same same call at $17 a piece. So let's say for $5, how much you would have got versus how much you would get for this is, you could see basically. So um,
$12 something.
so you would get $17,000. All right, if you were to sell that call that you bought for $5 last week, anytime if it goes 17, you'll receive $17,000. But let me cancel this. If you were to buy this call that's at 5, let's assume that you bought this at 5. So let's execute that at 5. Single at let's say you bought this at 5. So last week you had paid $5,000. But if you were to sell it now or next week at $17, you would basically get $15,000 different. I mean, $10,000 different, $12,000 difference. So you'd have made $12,000, assuming that the stock went this much higher.
So that's the power of leverage, right?
Correct. But the same goes back to puts. So that's assuming that you bought last week this same stock, this same option, this option strike price 430, the expiry December 24th. Let's say this was last week at $5, then you would have paid $5,000. But if you were to sell it now, it's at $17,000. You would get $17,000 for the same thing. Whatever you bought at 5,000, now you can sell that at 17,000. If you hold on to it and stock continues to rise, then after 24th, if this were to what was the term? I forget. It gets executed. Then let's say January 1st, you never did anything on it, you just sat on it. Then on January 1st, you would have 100 stocks of Tesla, and you would have paid 430 on it, on each stock. And even though stock may be 600, you still have paid 430 on that.
Okay, just a question like I just want to understand the time decay.
Yep.
So, for example, if I assume that Tesla will go to $500 next year by February 1st,
All right, February
and
1st,
I
that's
buy,
here we go, February 1st.
yeah. So if I buy call options for that,
At what strike price? So you said something, it will go to 700,
five
500.
500.
All right, so let me see. Let's say if it goes on 500, that's going to be very difficult. So let me close December. All right, so this is January 31st. Actually, let me make February 25th because end of February. So you're saying, as this is a popular stock, a lot of people. By the way, this is where the strike, the strike price right now. Everything yellow calls are in the money. Everything yellow is puts are in the money. That's what it means. So let's
So
say
I have to
500.
buy, so I have to buy something in the money or
No,
at the
you can
money,
buy
or
anywhere you want, but in the money is always basically when the expiration comes. That's when your value of your stock will remains higher. So, for example, if you had a how do I switch? Let me switch for a quick second to so if you had a option call at 437 last week, then this would have gone zero because this is expiration date 6 days. But because the stock price never met, everything would have been zero. Like for example, if you had, let's say, one call at 437 and the stock never reaches 437, you would basically, this will become null and void. This will become zero
when? At the
on
expiry date or before?
expiry date on 24th, if the stock doesn't go up.
Okay, coming back to my example for
Yep, let's go to your
Tesla.
example. Maybe it makes
Yeah.
sense. All right. So you said you want to buy February 15, February and 500 strike price of 500. You want to buy calls, you were saying, right?
Yeah.
All right. So let's say you buy one call. Let's stay with one call. All right. So you buy one call. Let's say the current price is at $48 per call, whatever. So you basically have to pay $5,000 for one call, and then you stay in that. And come
So whatever the expiration date is, so whatever happens to the price within that time period, can my option become zero?
no, your option value will become zero. On actually, I chose I don't know why I chose April. I thought I chose February, but on April 25th, I actually chose the wrong one. But is it okay, or you want me to go back to February?
No, it's okay.
Okay.
Like,
So April 25th, if this particular stock does not hit 500, then if it says anything even 499, you would lose all these $4,000. That will become zero, and you do not have to do anything. You just lost your premium.
So if
Versus,
Tesla price really goes down, my question is there any point in between that period before the expiry date? Is there a possibility that my option can become zero or no?
no. So
No?
you're buying a nothing happens at the same time you're seeing it. You have the option to liquidate any time, but
Mm,
um, let's say you bought it today already. You already have
yeah,
this particular call. So you paid what?
yeah,
$5,000.
yeah.
And this is expiring on April 25th. If in
Mm,
January 15th, stock goes really high, stock goes to 800, the value of this keep going up and down,
mm,
but
mm,
nothing's going to happen until you execute it. So when it goes to 800, this is right now we are buying at 48. If it goes to 800, this will become $348 each. All right. So you
uh,
would, um, but unless you execute, nothing is going to happen. And then by the time April comes, let's say it goes up and it already goes down. And let's say on April 25th, the stock is at 499, then this will be zero. If on April 25th, if the stock is at let's say 510, then you would get basically $10 each, so you'll get $1,000 back.
okay. So until the expiry date, I can still wait, right?
Yeah, there's nothing you could do. So it's just like you're buying a stock. You already bought
Mm,
this. It's in
yeah.
your possession. You have the contract to buy this many.
Mm.
But if the stock goes up, you're guaranteeing yourself this particular price point, $500.
So
So even the
even
stock,
for, yeah.
go ahead.
So even if the stock goes, let's say it's never going to happen, but $0 for Tesla.
Yeah,
So
the maximum you
for a
lose is
day.
this much. Oh, for a day, if it goes zero, then nothing
Yeah,
happens in that during that time frame. It can go up and down. If
yeah.
you can exit, by the way, if you, let's say in the other way around is, let's say it's 500 strike price right now. Let's say from now until April, it
Mm,
goes to $900 one day.
mm,
The premium you would collect is a lot higher, so you would basically collect
mm,
448. If this
mm,
was 448, then you say, you know what, this is a good point. You could sell your call, and you'll
mm,
basically get to keep that particular premium. Let's say you already paid
mm.
5,000,
Yeah.
assuming you already have this, and let's say in March or April you have this,
Mm,
so you want to sell this particular call. Let's say this is $400. You would
mm,
not believe the premium. So you would basically collect $400,000 on that
mm,
if the stock hits at let's say 800, and then after a month it goes down again. Once you exit, obviously you exit, you already take your profit, you're out of that.
mm. Okay.
But you're never owning the stock, by the way, from Islamically and all that stuff. So you're never owning the stock. So for that reason, also a lot of folks do say these options are not halal. So I just want to I gave that disclaimer earlier on. All right, that's kind of basic of it. I have a little bit more time if you guys want to. I can hang around, but that's the gist of buying calls. And the option puts are very similar to that, just opposite of that. Again, when you buy puts, you're basically buying insurance against your stock, or even if you do not have it, you're buying an insurance policy, if you would. And then if the stock goes really down, if it becomes zero, then you get to keep all that premium, all that insurance money you collect. If it goes up, then you lose it. So that's the difference between puts and calls.
And is there any option to roll over after the expiry date, or you just have to exit the position and buy again?
You do not have to do anything once exit happens. So for example, let's say you have let's go back to uh, oops, actually I think I could do this 28 also. And I'll just keep it simple here. Let's do just last 10. So let's say you already bought one call at strike price at 435 on December 24th. If you don't do anything, and then stock still remains below 435, then all you lose is whatever $1,500, and you do not have to do anything. In this, basically, you lose that particular option, goes zero, it goes away from your platform. If it goes, let's say if it is 436, then you have the obligation to purchase 100 stocks at that point at 435.
So there's no option to extend my expiry date.
No, you just basically buy another call. If
Mm-hmm.
you want to extend, your expiry date. That's why. So let's say December 24th, the stock is still higher, then you're already in positive. You just sell that stock. I mean, sell that call, and then you basically go into the next one and you buy another call.
Okay.
There are multiple other strategies called straddle. I didn't really talk about it. What you could do, people can do is, um, where's that? I don't know, it's not letting me. What you could do is you could buy, uh, let's see if it gives me custom. Let's see. So these are some strategies I had a long time ago, but I could do back and forth. What is actually stocks? You could buy a pair, so you could buy a option and a call together at the same time, and then these are different strategies you could do. That's called straddle. So sometimes if a stock goes up, you want to buy some calls, and then you want to put some puts also on the side. So this way you're protected against any stocks you may have, and then if stock goes really high, then you have the option to buy some option, calls as well. So you could do straddle. I'm just using wrong strategy here, but you could do that stuff also. A lot of times, let's say somebody have 1,000 stocks of something, and then you want to buy a put against it, and you could do that, or you could sell some calls. Let's say, for example, again, let me delete this. Delete. Let's say I have 100 Tesla, and I know that Tesla is not going to go. Let's say assuming that I already have 100 Tesla, it's a big position, but I know I don't want to lose my Tesla. However, I know that Tesla is not going to go to let's say $800, or well, nobody's doing it. Let's say Tesla is not going to go to 720, and I want to sell some calls on it. So I could certainly do that. Um, what it does, it gives me the option, but as you can see that nobody's even bidding on it. But if I can demand, let's say, I could say, you know what, I could collect $1 on it. Um, so if I have 100 Tesla, I could sell one call. I get to keep $1,000. When the expiry date comes in, I just get to keep $1,000. That's the leverage that I have because I already have the stock and nothing will happen to me. But again, nobody would people are also smart, so nobody would bet that much money that far if it's not going to happen.